The different phases in an economic cycle may be used for tactical asset allocation. The key is to identify the asset classes which outperform during the different phases of the cycle. One approach is provided by David Ranson, who boils down the market drivers into two indicators. The first indicator describes the financial risk in the market. It's given as the yearly change in the spread between the BBB and AAA corporate bonds. When the yearly change is positive and the spread expanding, it indicates a higher uncertainty in the market. The second indicator is given as the yearly change in the price of gold. It measures the currency depreciation risk, which increases when the debt of governments become alarmingly high due to massive fiscal spending. Using these two indicators, Ranson creates different scenarios depending on whether the indicators are positive or negative. And in this whole landscape, he maps out the different asset classes which outperform during the different scenarios. Since 2016, we've seen that the corporate spreads have narrowed less and less and are now actually slightly expanding. The change in the price of gold has been varying a little bit, but is now slightly positive. This brings us to the middle of this landscape where no asset classes are expected to outperform. This stresses the importance of having other non-traditional assets in your portfolio, such as emerging market exposure and commodities. With the uncertain global political environment and the highly indebted financial systems, these two indicators may be interesting to monitor in order to follow the change in demand between the different asset classes in order to boost your asset allocation strategy.